It's 10 a.m. right here in Lagos, Nigeria, as a TGIF trade, and in this holiday shortened trading week that ends today. But definitely, it's been quite a dramatic trading week, and definitely we still got the attention, all attention, still on oil. And we're seeing this morning oil prices trading higher amid persistent tensions around the Strait of Hormuz, with the vital shipping lane still largely closed despite a ceasefire deal between the U.S. and Iran. U.S. West Texas Intermediate crude futures, that's for May delivery, that gained about 0.7%, about $98.58 per barrel during early European hours. And there you have it, 1.85%, just like yesterday, higher. And WTI still continues to outpace Brent by price, 99, smack on there, heading back to the $100 mark at this point. That's talking about WTI, 1.62% higher, and definitely we know most countries, they don't want to see this rise right now. They would like to see more de-escalation, so the price of oil can come lower, and when we get to the pumps, we don't have to pay so much for fuel. But at this time, not looking good for that prospect there, but it's still good for major oil producers at this point, just like Nigeria. All right, let's get to other matters now. That's looking at the NGX. Let's see how your money performed yesterday. We gained 28 basis points to close at 203,000 points. Yes, this is a new high at this point. Driving year-to-date gains to about 30.56%. So it's been a great quarter. That's Q1 for the NGX. The performance was driven largely by gains in stocks like Nestle, Zenith Bank, and GTCO. We see the banks getting a lot of attention. Zenith, GTCO, they did release their earnings for 2025 full year, and it's been good so far. And I'm guessing investors are reacting to that. And some of the dividend announcements right there. Our trading activity, though, 652.86 million traded yesterday, valued at 39.82 billion naira. Deals 51,000. That was traded. So definitely we did see investor appetite there, but more on select stocks. The flip over now to some of the gainers from yesterday. We see the likes of UPD Credit there, 9.63% advance. If we look at the laggards at this time, that's for yesterday. Maybe you might give direction for the TGIF trade today. Let's see if the bulls continue to hold on to the market. Definitely, but we'll get a review of what's played out so far and what to expect for next week. We'll see Living Trust, that top the losers chart, 10%, big full 10% drop there for that stock. All right, let's gauge performance for the week and get an outlook for next week. Joining me now is Mr. Tunde Amolegbe, is the MD of the Stephen Asset Management, joining me via Zoom. Great to have you on the show, sir. Good morning.
It's my pleasure to be here, Aladi. Thanks for having me.
Yes, nice hat. I feel like calling you Alaji right now. I guess you're ready for the TGIF trade today. But so far this week, we're up about 0.7%. Week to date, we still have one more trading session today. We'll see if it adds more to this week-to-date game. But so far, it's looking green. How do you see the play out this week? Despite the war in Iran, we get de-escalation. Next thing, we're getting escalation.
You see, the markets, the local markets, at least Nigerian market, is still riding the back of the macroeconomic reforms, the impact of the macroeconomic reforms we've seen in the last, I would say, 2 years. I personally do not feel those reforms have been completely priced into the market yet. So, despite the fact that we are seeing global upheavals that should typically impact the global economy, it will appear as if the Nigerian stock market is brushing that aside. The impact of the global upheaval, and essentially focusing on the impact of the reforms and how they are playing out in the local economy. And that is why you still keep seeing the stock market the local stock market continue to do well, despite the fact that, you expect that, a market that is as correlated with the global market as ours is, what is happening in the global economy should also be impacting us. But we are not seeing that because, the focus really is still on the impact of the macroeconomic reforms we've seen. So dollar is still the exchange rate of the dollar to naira is still relatively stable. Interest rate is not galloping as it was. To all intents and purposes, we've not seen galloping inflation too. And obviously, as you've seen with the earnings we've seen and the corporate announcements we've seen recently, local companies are doing pretty well. So these are the issues that the stock market in Nigeria are focusing on, rather than focusing on really what is happening globally. And that is why you still see our market continue to do well despite all the global upheaval.
Right. It's quite interesting, when you see the volatility in the metals market, we've seen how far gold has had to retrace. We've seen how that has impacted mining stocks listed on the Johannesburg, stock exchange. That has lost, so much from the previous high, from about 120,000 down to 109,000. So a big drop, so far on that exchange. But we also got reclassified. The FTSE Russell, we got, readmitted that into frontier markets. And I'm sure there's been reactions in your industry with the CMOs at this point. What have we seen so far?
Well, again, that's another positive sign that, the reforms are bearing the fruits that we expect them to bear. You will see that in the report that FTSE released, they said one of the main reasons why they reclassified Nigeria from standalone to frontier markets is the stability of the FX market and the liquidity of the FX market, meaning that foreign portfolio investors, for instance, that come into our market are able to, have easy access in and out, and that is what they expect to see. All right, and that is why they are saying we are seeing that reclassification. And what that reclassification now does is to open the way, or open the door, if you will, to some of these index funds, some of these global index funds that have been sitting by the wayside and have been cautious to come into the country. So now say yes, if we have now been reclassified, they can now start including Nigeria in their portfolio again, and that again is likely to result in even more activity in the market, and most likely more bullishness to follow. All right, so it's just opened the door further for more investors, particularly foreign portfolio investors, to start, coming into the country. Of course, there are some other indexes we are still expected to hear from. There's the MSCI index that typically also, provides, if you will, certification for foreign portfolio investors to consider, including Nigerian assets in their portfolio. But the FTSE announcement was clearly positive for the Nigerian economy and for the Nigerian stock market. So the expectation is that will also continue to provide impetus for investors to continue to look at, Nigerian assets to include in their portfolio.
Rally we've seen so far, I believe that's been, largely driven by local investors at this point. I remember before now when we had, enough foreign participation. Back then, there were complaints about, the foreign investors, pulling out funds, dragging the market down. So now we're going to get them back in at this point.
Absolutely.
Are you guys seeing any risk?
And I'm happy they're coming in, and I'm happy at the rate at which they're coming in. But I'm even happier about local participation, because one of the problems we had in the past was that you had a situation where the foreign investors came in and they absolutely totally dominated the market. At some point we had 60-70% foreign participation in our market. That wasn't healthy. And what you now saw was that, the moment the global financial crisis hit, they carried their bag and dumped and left. And, the market took a while to recover. This time it is different. Foreign participation, I believe, has moved from about 5%, from a low of about 5% to something in the region of 25% at the moment. But you will see that local participation, both institutional and retail, have also grown significantly. We've moved, for instance, from having maybe about 100,000 active retail CSCS accounts to a situation where we now have close to 2 million active local CSCS accounts. That is fantastic for our market, because what it does is to provide the sort of stability we need. So in case there is a global shock again, and these FPIs have to exit our market, you will not see the kind of precipitous decline in share prices that you saw in 2008, 2009, because the local investors are more stable in terms of their investment, in the tenure of their investments, and their ability to withstand risk and shock. So they will provide this sort of stability that every market needs in case of crisis, so that you don't have this unhealthy gyration in share prices simply because there's an event somewhere that might not even have anything to do with Nigeria impacting our market. So all in all, we are clearly moving in the right direction in terms of where we should be in terms of investor participation in our market.
All right, so next week we're expecting data, inflation data. Most analysts and experts are dreading the March inflation data in different countries at this point. And for Nigeria, I guess consensus is there will be an uptick, seeing what's played out with energy prices so far. Do you think the bulls in the markets will shrug that off, knowing fully well that that could lead to more rate hikes, or we switch direction when it comes to interest rates? Instead of the cuts and the hold, we might be seeing hikes again.
I also believe that it's very likely that we're going to see an uptick in inflation levels, because energy prices have really increased tremendously in the last few months. Primarily, of course, due to global events and the crisis in Iran. But the reaction of the market will be determined by the level of uptick we see. If the uptick is extremely significant, then the market cannot possibly shrug it off. If we end up seeing a 200% or a 200 basis points or a 300 basis points increase in inflation rates, then of course, there's no reasonable analyst will shrug that off. However, if other issues, other contributory factors to inflation are able to balance out issues around increase in energy prices, then investors might not react as aggressively as they should. So, for instance, if despite the fact that we have seen significant increase in energy prices, we have not seen increase in food prices, for instance. Food is a significant contributor to inflation levels. If we've not seen significant changes in FX rates, for instance, those could sort of serve as a balance to what we have seen regarding increase in energy prices, and those are part of the issues that analysts will look at and come to a determination as to the likely impact on the companies operating within the economy and companies that are listed on the exchange. So I will say that we will need to wait to see how the energy price increases actually impact core inflation at the end of the day, and the quantum of increase we see in inflation rates, in order to be able to determine how the market will ultimately react.
All right, so first quarter on the NGX dusted, fantastic gains so far in Q1. What do you think is the strategy for investors, or investors should actually look to imbibe in this second quarter? It seems like we might have another blowout quarter again at this point. Where should investors be looking at this Q2?
It's clear that the market still has some room to run, in my own opinion. I think the market still has some room to run. Some fundamentally strong stocks still appears to be relatively cheap for me. If you look at the price multiples for some of these stocks and compare them to peers in other jurisdictions or similar jurisdictions, you will see that relatively they are still cheap. I still feel that the impact of the macroeconomic reforms we've seen have not really been factored, as I mentioned before. And of course, we are still seeing earnings reports coming out. Some corporate actions have been declared that are quite impressive. The expectation is that we're also going to start seeing the first quarter results of some of these companies being released towards the end of April and early May, and that will also give us a gauge as to whether the performance we have seen for some of those companies at the end of 2025 is continuing. All right. So if those earnings reports for first quarter follows the trend we've seen at the end of 2025, then of course that should also serve as additional impetus for investors to continue to look at some of those stocks. So the strategy I will advise is that for investors that are targeting that are long-term investors, is to position in the fundamentally good stocks. We know most of those fundamentally good stocks. Position in them, get your dividend and wait. All right. For traders, of course, the volatility that is expected from global events might have not happened in Nigeria, but it does not mean that there still not exist opportunities for trade. There still doesn't exist trading opportunities. But my preferred strategy is for investors to have a relatively long tenure for holding their investments, position in long tenured, fundamentally strong stocks, collect your dividend, and just wait. And I think that at the end of the day, they will see they've done well.
Thank you so much. Definitely, we'll still keep analyzing these markets and investors' expectations for some of these earnings, because it's earnings season, and definitely that will still keep driving sentiment. Thank you so much, Mr. Tunde Amolegbe is the MD Arthur Stevens Asset Management. Thank you for coming on today, and TGIF.
The pleasure was mine. TGIF to you too, Ladi. Thank you.